Before we go into options trading strategies and all the other technical, let's talk about the basic definitions of options, and why they even exist in the first place. Make sure you stay till the end of this video, as I will be sharing something nice for you. What's an option? To understand what options are, it helps to compare them with stocks. Buying stock means you own a tiny portion of that company, called a share. You're anticipating the company will grow and make money in the future, and that its share price will rise. If this happens, you can sell the shares for a profit. An option, on the other hand, is a contract that gives you the right to buy or sell a stock, usually in bundles of 100, at a pre-negotiated price by a certain date. However, when that date arrives, you're not obligated to buy or sell the stock. You have the option to let the contract expire, hence the name. However, when buying options, you'll pay what's known as a premium upfront, which you'll lose if you let the contract expire. Okay, I know this can be confusing, especially if this is new to you, but just bear with me a little, everything will make sense once you've finished watching this video. There are two main types of options contracts. Number 1, call options. A call option gives you the right to buy a company's stock for a specific price, known as the strike price, within a specific time period, referred to as its expiration. Number 2, put options. A put option gives you the right to sell a company's stock at an agreed-upon strike price before its expiration. Once you buy the contract, a few things can happen from the time you purchase it to the time of expiration. You can exercise the option, meaning you'll buy or sell shares of the stock at the strike price. Sell the contract to another investor. Let the contract expire and walk away with no further financial obligation. Example of a call option. Let's say a company's stock is currently $50 per share. You could buy a call option to buy the stock at $50, the strike price, that expires in 6 months, for a premium of $5. Premiums are assessed per share, so this call option would cost $500, $5 premium x 100 shares. Note that when buying options, you'll choose from an available list of strike prices, and it doesn't have to be the same as the current stock price. If the stock price remains at or drops below $50 during the 6-month period and never recovers, you could let the contract expire worthless, and your total loss would be the $500 you spent on the premium. That $500 is also the maximum amount you could lose on the investment. Now let's say the stock price rises to $60. You could exercise your option to buy the 100 shares at the strike price of $50, then turn around and sell them at $60. In this instance, your return on investment would be $500. It would cost $5,000 to buy the shares, but you would sell them for $6,000 for a gain of $1,000. Subtract the cost of the premium, and you're left with $500 profit. When buying a call option, there will be a break-even point at which you'll earn a profit. In this example, that break-even point is $55. So, if the stock is trading between $50 and $55, you would be able to recoup some of your investment, but it would still be for a loss. If the stock price rises above the strike price, the contract itself gains intrinsic value, and the price of the premium will rise accordingly. This means you could sell the contract to another investor before expiration for more than you bought it for, taking a profit. You'll have to look at several factors to determine whether you should sell an options contract or exercise it. Example of a put option. Put options serve a similar purpose as shorting a stock, both let you profit if the stock price falls. But puts can also be used as a hedge against price drops that might hurt your portfolio. Using the same example above, let's say a company's stock is trading for $50, and you buy a put option with a strike price of $50, with a premium of $5 and an expiration of 6 months. The contract costs $500. Let's say you bought the put option and the stock drops to $40, but you don't own it. You could buy the stock at $40, then turn around and sell it at $50. This would return a profit of $500. You would buy 100 shares at $40 for $4,000, then sell them at $50 for $5,000, generating $1,000. Subtract the $500 premium, and you earn $500. If the price rises, the contract will expire worthless, and you would be out a maximum of $500. In a sense, put options could be considered insurance for your stocks. If the stock price falls, you're insured to sell at the higher strike price, and if it rises, the premium you paid was the fixed cost of that insurance. Like call options contracts, a put options contract can have intrinsic value. If the underlying stock price drops below the strike price, the contract will become more attractive, and the cost of its premium will rise accordingly. In this case, you could sell the contract to another investor for a profit. Why buy call options? If you think a stock is going to rise, you can either buy and own the stock outright, or buy call options. But there's a big difference between these two. In the example above, notice that it costs $500 to take control of 100 shares of a stock valued at $50 per share. If you were to buy the stock outright with the same $500 investment, you would only be able to take control of 10 shares. This is where the return magnifying power of options comes into play, and why options are considered a form of leverage. From the example above, we know that if the stock price rises to $60, it yields a $500 return. You've doubled your money. If it rises to $80, that's a 60% increase in the stock's price that resulted in a return of $2,500. Had you bought the stock outright, that same 60% price increase would give you a return of a comparatively meager $300. But where there's the chance for high reward, there's high risk. If you'd invested $500 in the stock outright, a subtle dip in the price doesn't mean much. A 10% decline, for example, means you'd be down $50, and you can wait indefinitely for the price to rise again before selling. Spending $500 on a call options contract, though, means a 10% drop in the stock price could render the contract worthless if the stock price falls below the strike price, and you have a limited amount of time for it to rise again. If it doesn't, that's a $500 loss, or 100% of your investment. Why put options? When buying put options, the max amount you can lose is similar to call options. If the stock price rises above the strike price, you'd let the contract expire, and you'd lose your whole $500 investment. However, the magnification of returns we saw in call options goes the other way in put options. If the stock price drops to $30, you would see $1,500 in profit. At $20, profit would be $2,500. But this also means there's a limit to profit on put options. The stock can't go any lower than zero. Conversely, when buying a call option, profit potential is theoretically limitless. Knowledge is power in options trading. Options provide traders with a greater choice of ways to express a market view. Since options can add considerable complexity to your trading activities, however, you will want to educate yourself thoroughly about how to best use them so that they boost your bottom line as a trader. You may want to take an options trading course, read relevant articles, watch related tutorial videos, and even hire an options trading mentor. Your online options broker could also provide you with its guides and tips to train yourself with, so check to see what it offers. In the next video, I will be teaching you what are the option trading strategies that you should know, and what are the trading strategies that I use to make me a millionaire. So, why so serious?